In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how SEBI has recently uncovered two scams that were happening with SMEs and what it really means for investors like you and me. And in the second story of the day, we'll understand what exactly is happening with the auto sector of the country with respect to numbers from January 2025. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 12th of February. See, over the past couple of years, SME stocks in India have been on a wild ride. The BSE SME index has almost gone up in a straight line during this time period. But the thing is, behind all of this exuberance, there are many ridiculous stories. There are multi-baggers everywhere. SME stocks have regularly seen over 10 times growth in a single year. Last August, for instance, the IPO of a company with just 2 automobile showrooms was oversubscribed 400 times. And this is just one such story, mind you. There are countless other similar stories when it comes to SMEs in India. And because of this very rapid rise, many investors, right from small retail traders to large institutions, have been buying shares in the hope of making quick profits here. But the thing is, in many cases, this particular exuberance does not really come because of strong earnings or genuine business growth. It actually comes from the place of fraud. And I'll explain how. See, there is a lot that someone with malicious intentions can get away if they're running an SME. SMEs have lighter compliance requirements, they get less coverage from analysts, and they also experience minimal institutional checks. And while all of this has been done to help SMEs, the thing is, it also makes it a perfect recipe for fraud. One can really exploit these structural gaps in the SME listing ecosystem and really get away with it almost very easily. Now, SME companies sometimes spread false news in order to make their shares look valuable as a result of this. For instance, they could claim to have won a massive export order or to have entered a lucrative new business altogether. And if investors like you and I end up believing these particular claims, we rush to buy these stocks. And since these shares have limited availability in the market, even a little bit of investor interest here can really send the stock prices up. And then, of course, insiders from within the company like promoters and directors end up selling all of their shares to excited investors. And therefore, I said that with all the limited scrutiny they receive, it can be relatively easy to pull off such a run in an SME stock as compared to a different kind of stock. And that is why today I have two cautionary stories for you. See, SEBI has recently tightened its regulations around SMEs, and while doing so, they have uncovered scams involving two companies. The first one is Kalahridhaan Trendz Limited or KTL, and the second one is LS Industries Limited or LSIL. Let's start with KTL first. See, in September and November 2024, SEBI received a complaint from HDFC Bank. The complaint was basically against KTL, which is an NSE-listed SME firm in the textile business. HDFC Bank complained that KTL had defaulted on loans and credit card dues and had not really made the necessary disclosures to the exchanges. Now, it seemed like a simple matter which involved less than 1 crore of rupees. But when SEBI started digging in, they realized that all of this ran much deeper than that. See, soon after listing, KTL had made various announcements. They claimed that their profits increased by 25% and also that they were making strategic expansions. Prices went up 300%. And 1 month after that, they announced that they had received an export order worth 115.5 crore rupees from a Bangladeshi textile company called Bexim Corp Textiles. Now, this was obviously a massive amount and therefore a massive news for a small textile firm, so the share price jumped by 20% in just one day. But the problem here is, there is no real proof that any of this ever happened. When SEBI actually ended up looking things up, they found out that Bexim Corp Textiles did not even exist. The company had faked emails and contracts to make a deal look genuine. You might ask me why? That is because they were likely driving up the share price so that its promoters could sell their shares at hefty profits. Now, incidentally, KTL's directors resigned just before the scam came into light. They perhaps knew that things were going south for them. And KTL, mind you, did not even stop here. They also announced a rights issue which lets existing shareholders make a further investment in the company. And this new issue was as big as the company's IPO itself. If it went ahead, investors could lose even more money to a company that, at least at the surface, seemed malicious. But now that SEBI has figured what's happening here, they have frozen trading in KTL stock and have also banned its directors from trading. They now plan to begin deeper investigations into the company to uncover more such secrets. Now let's move on and talk about the second company, which is LS Industries Limited, or LSIL. Now this is another textile company and it had been suspended from trading for 11 years since 2013. But when trading resumed in July 2024, its stock price shot up by more than 10 times. In just 2 months, it went from 22.5 rupees to 267.5 rupees. Prices swung wildly for a while before it finally settled around 68 rupees by February 2025. Now, of course, the thing is, companies do see their stock prices rise and fall all the time. But I'll tell you what makes the whole thing very puzzling. This company had almost no revenue, they consistently made losses, and they also did not have any business activity to show. So the question is, why were people so keen to buy it? See, SEBI believes that this was a classic pump and dump scheme. As soon as LSI's share began trading again, a small group of traders began placing regular buy orders. Now, these orders would come in before market hours at well above upper circuit. As the price zoomed by 1089%, the company began making fantastical announcements. The company claimed that it was venturing into AI and robotics. They also announced plans to rename themselves as AI Tech Limited, bring in foreign directors, and also open a Dubai subsidiary to develop robotic chefs and also try hydroponic farming. And then, within just 2 months, the stock crashed by 84%. The very traders that were bidding the company's price up began selling as soon as they could. New buyers were obviously stuck with a heavily illiquid stock. And meanwhile, one more interesting thing happened. One of the company's directors had sold crores of shares to a Dubai-based NRI for just $1 a share. And the whole thing seemed extremely shady for obvious reasons. And when SEBI dug into this, they found out that none of the company's AI plans were real. Their revenue was negligible and they had no actual product and no business activity at all. SEBI has now banned LSI's director and the Dubai-based NRI from trading. They have also frozen bank accounts and impounded over 1 crore rupees. And they have also opened a detailed investigation into this matter. So the question here is, with all of this information, what do we really do? See, these two scams are more like a cautionary tale for you and I as investors. SME stocks at the face of it can definitely look like they're poised for breakaway growth. But sometimes this is like an illusion to us. Companies that are looking for quick money can sometimes engineer pump and dump schemes. Because after all, while it is hard to grow your business exponentially, it is definitely a lot more easier to fool someone into thinking that you're doing that. And as an investor, if you think that you're sitting on a once-in-a-lifetime investment, it is also important for you to ask yourself if it's really true. Because if someone has hooked you in with false news, there are chances that they have already made their exit by the time you actually realize you've been scammed. Now, of course, let me tell you, not every SME stock with a surging price is fraudulent. Some genuinely end up doing well, sign major contracts, and also move into lucrative new businesses. And that is why for all of us as investors, it is very important to understand the difference between real opportunities and empty hype. All of us need to do our diligence, keep an eye out for suspicious behavior, and also be very, very skeptical of all the kind of news pieces that sound too good to be true. And with SMEs, this is specifically very difficult because detailed and reliable information on SMEs can be very hard to find. And that is why you should only invest in them if you really know what you're doing. With that, let's move on to the second story of the day and talk about how the automobile sector is doing. 2024 was a bit of a mixed year for India's automobile industry. On one hand, throughout the year, the industry delivered a fairly robust performance. They found answers for various old issues from semiconductor shortages to soaring input prices. And across segments, they delivered record high sales. But the thing is, on the other hand, there were plenty of pockets of concerns. The market seemed to have shifted significantly with a distinct move towards more premium vehicles. Customers bought a lot of utility vehicles, which made up nearly 2/3 of all passenger vehicle sales. And at the same time, traditional vehicle segments like sedans and hatchbacks appeared to have declined in popularity. By the end of the year, manufacturers began resorting to deep discounts in order to get rid of their stock. This was particularly prevalent for older and entry-level models. 2024 was also a bit of a nightmare year for commercial vehicles. Sales of buses, trucks, and tractors, all of them suffered for large parts of the year. January 2025, though, has been a great month for this sector. Now, India Data Hub, which covers a lot of data and insights from different industries across the country, has done an interesting report on this. And that is exactly what I will refer to here. Now, over this entire story, I'll find answers to some very key questions. First, how has the automotive sector really opened up the year for us? Second, what trends we see across different segments? And third, which companies are gaining ground and which ones are really falling behind? And while we try finding answers to all of these three questions, we'll also try and figure what this data tells us about sustainability in this sector. Now see, the month of January 2025 gave us some very interesting answers to all of these questions. So let's actually understand what's happening here. See, in January, the overall auto sales grew by about 6% compared to the same month last year. But more importantly, this growth was very broad-based, and this means every single segment saw some degree of year-over-year growth over the entire month. Now, for most of the industry, January marked a very distinct improvement over December. But if you look closely, you'll realize that this recovery is not really evenly spread. While some segments are definitely doing well, growth is actually muted in some of the others. Basically, while some companies are gaining ground, the others are struggling to keep up. Let's start by understanding cars and utility vehicles. See, after 2 months of subpar performance, the segment shook off its inertia and registered growth of 15% year on year. January 2024 itself had seen high growth, so this particular growth was over a high base as well. The two-wheeler market also showed some signs of recovery. After a steep decline of 18% year-on-year in December, two-wheeler sales bounced back with 4% year-on-year growth in January. Now, of course, there was nothing spectacular here, but it is definitely an encouraging sign. Now, such a comeback in passenger vehicles is definitely a great sign. Cars are a huge purchase and people rarely buy them when they feel insecure about their future. Strong growth in this segment indicates high consumer confidence. When people and businesses both feel comfortable enough to make such big ticket purchases, it is very likely that they nurse a positive outlook towards the economy overall. Commercial passenger vehicles also saw a strong month of growth. Sales of buses and other passenger vehicles, which by the way include minibuses, vans and other such vehicles, jumped by a massive 30% year on year, which suggests that public transport and intercity travel are picking up. Notably, last January, the sales in this segment had shot up by more than 50%. So this growth is obviously over a very high base and that is something we should be careful about. But that said, not every category of vehicles had the same luck here. Tractor sales had been buoyant towards the end of 2024 after a fairly rocky year with many months of poor growth. In January though, growth moderated again to just 4%. Now, there are many ways to interpret this sharp slowdown in tractor demand. On one hand, farmers often make their purchasing decisions on the basis of agricultural cycles. It is possible that they front-loaded their purchases early in the sowing season and there is now a natural dip because of that. But then there is also a possibility that we are looking at base effects. January 2024, for instance, had seen a 20% plus growth after a dull closing to 2023. So this year's figures might just indicate a return to normalcy. There's, by the way, also a more pessimistic reading of the situation. Rural markets, which had been quite strong until recently, might be showing some signs of softening down. This slowdown could mean that rural incomes are not really growing as fast as before, or that farmers are now holding off on big purchases. It obviously may be too early to come to a conclusion based on such small data, but given how important rural demand is to India's overall economy, this is something definitely that's worth watching. Let's then move on and understand how different companies are doing. Let's start with two-wheelers here. The sector's growth this January was led by TVS and Eicher Motors. Both of these companies saw their sales rise by more than 12% as compared to last year. Their growth made up for a dismal month for many other companies. Ola Electric, which is one of the bigger names in India's electric scooter market, had a disastrous month of January. They saw their sales drop by 25% year on year, which was the second straight month of falling sales for Ola. And if they don't really find a solution to this fall, Ola could be facing some serious challenges very soon. But overall speaking, Hero continues to be the biggest player in the two-wheeler market, holding about 31% of the market, followed by Honda at 25.2%. But interestingly, TVS has been gaining ground here and they now hold 17.3%. Meanwhile, on the other hand, Ola, which was once looked at as the future of electric scooters in India, has not really made much of a dent at all. Its market share has stagnated at around 1.3% and is on a downward trend right now. And this is especially worrying given the sector's wider trajectory. Overall, electric two-wheelers saw about a 19% growth even as Ola's sales were declining. Now, of course, all of us need to realize that 2 months is a very short period of time and this might very well be a bit of a hiccup. But if it continues this way, it may suggest that established brands like TVS and Honda are doing a better job at attracting customers towards electric vehicles. Let's then move on to four-wheelers, which logged impressive growth in January as well. Toyota and Mahindra were the standout performers here. Toyota led the way with sales rising by a massive 37% from last year. Mahindra too delivered an impressive figure of 20% year-over-year growth. Even Maruti, Hyundai, and some other luxury brands which had struggled in the month of December saw their sales grow between 15% and 20% in the month of January. Tata Motors, on the other hand, was a bit of a contrast here. They were the only major manufacturer to see a decline in sales, down by 0.6% compared to last year. This was Tata's third straight month of negative growth. Now, Tata is evidently facing difficulties in maintaining demand for its cars because of this. But that said, this decline was much less dramatic than what it saw in the month of November and December 2024. So it might really be a sign that the worst is already behind it. But still, we'll have to wait and watch. But if we look at the overall numbers, Maruti continues to dominate the four-wheeler sector with a market share of 42.5%. Hyundai, on the other hand, owns about a quarter of the market, while the remaining market is split up amongst other auto majors. Toyota, perhaps because of its strong SUV offerings, has consistently done well over the last year. Luxury brands like Audi, BMW, and Mercedes together make up just 1% of the total sales, despite a healthy 16% growth in the month of January. Clearly, while high-end cars are growing, they remain a very small part of the Indian auto industry. Moving on, let me give you an interesting stat. Across the board, customers seem to be moving towards eco-friendly fuel sources now. Electric two-wheelers saw an impressive growth of 18.9% year-over-year compared to a mere 4% growth in the overall segment. And the story was the same for four-wheelers as well. While the overall segment grew by 15%, CNG car sales went up by 50% year-over-year, while electric car sales increased by 32%. Diesel cars, on the other hand, trailed the rest of the segment and grew at 9.8%. But that said, all in all, petrol still remains the dominant choice of most buyers in India currently. And in terms of overall market share, petrol continues to power nearly 90% of all the newly purchased two-wheelers, while electric two-wheelers account for just 6 to 8%. Similarly, petrol cars make up over 60% of sales, while diesel holds a market share of more than 15% right now. CNG cars, on the other hand, make for over 20% of all new car sales, up from 10% back in 2022. And this suggests that buyers are increasingly looking for more fuel-efficient and cost-effective alternatives, with CNG coming out as a clear winner. So all in all, the automotive sector's performance has been a bit mixed. While the sector's revenues have been growing, going up 11% in December, its profitability has been under pressure. In fact, in December, profits declined by 3% year-on-year, marking the second straight quarter of falling profits. And as companies scramble to offer major discounts, companies' EBITDA margins fell, meaning companies are earning less profit on each vehicle that they sell. So now, with all of these big points and insights that we have, the big question is, how should a person like you or I think of this sector as a whole? See, zooming out, this sector shook off a muted end to 2024, beginning 2025 on a front foot almost. Electric vehicles are becoming increasingly mainstream, though the growth is not really uniform. CNG cars are gaining quite some popularity too. But the thing is, this also ends up hiding underperformance by individual brands. Ola Electric, for example, shows a lot of signs of stress. And Tata Motors has also had a few bad months on the trot. Is January going to be a return for the sector, or will things go back to normal again? And second, will companies like Ola and Tata make a comeback? Both of these questions are such that they will have to be looked at very closely because they significantly shape how the auto industry is going to perform. With that, let's move on to the final section of the day, which is the quick news tidbits. First, Bangladesh has requested full power resumption for Adani Power's 1,600 megawatt plant in Jharkhand, which has been operating at just 42% capacity since November 1st, 2024. The shutdown of one 800 megawatt unit was triggered by delayed payments from Bangladesh and reduced winter demand. The Bangladesh Power Development Board, or BPDB, under a 25-year contract signed in 2017, has been paying $85 million monthly to clear dues. In December, an Adani source said that BPDB owed the company about $900 million, while BPDB chairperson said at the time that the amount was only about $650 million. Second, global hedge funds have ramped up their purchases of Chinese stocks, with the week of February 3rd to 7th marking the strongest buying spree in over 4 months, according to Goldman Sachs. Chinese equities are now the most net bought market on Goldman's prime brokerage book worldwide, with 95% of the purchases in single stocks across sectors like consumer discretionary, IT industrials, and communication services. The MSCI China Index rose for 4 consecutive weeks since mid-January, gaining over 6% in February and outperforming major global markets. Third, ONGC has signed an MOU with BP in order to collaborate on exploration and production, energy trading, and other business areas both in India and globally. This comes a month after BP was appointed as a technical service provider for the Mumbai High Field. This partnership focuses on bidding for offshore blocks under the Open Acreage License Program and sharing deep water exploration practices. That's all the news and stories I have for you today. I hope you enjoyed the episode and maybe learned something new from it today. This is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.